opinions expressed by the presenters and guests are their own, and they do not necessarily reflect those of Equitable Bank. This podcast is presented for general informational purposes only and is not intended to provide investment or legal advice.
Welcome back to Equitable Bank, more bank for your buck. Special episode this time. We're going to have a listener mailbag episode, and joining us all the way from Omaha is Erol again and Doug. Doug, old man Doug from Omaha. Doug, give us a little bit of your background before we jump into listener questions.
Well, I'm old. I'm 60, but no, I've been in banking all my adult life, 38 years. Been married for 38 years, so I think I'm steady, or at least I don't know anything else. But I enjoy banking. I enjoy the people part of it. I say I'm in a people business, not the numbers business or the money business or the banking business. I'm in the people business. Equitable, when I joined, I can remember in 2013, Tom had indicated that it was a very inclusionary management style, and that really spoke to me. And we have we call it ALCO, assets and liabilities. We're trying to match our money expense to our loan income, and we try to manage the bank's liquidity and also the overall operations of the bank. But best example I can give you is we switched core processors in 2018 from, I believe it was called Finastra, to Jack Henry. And it was an ordeal, but really our people made it work. And again, we've just got such a great support staff, a great operations staff that are there to help customers. So again, graduated from Wayne State with a banking and finance degree and economics. And that's really, sometimes I tell people I think I have a PhD in economics, even though I didn't have the schooling for it, because I've seen so many different businesses.
Sure.
Whether from trucking to dental practices to, I have a customer that picks up dog doo-doo and does quite well at that. And so I can't think of a business or an industry I haven't done something in. I'm not an expert in every industry, but I generally know what those numbers should look like and what challenges those businesses and industries have. And it comes down to people. Good businesses generally have good, smart managers behind it. And so those are the things I look for.
We're going to tap into your expertise today, and you're going to help us navigate through. We've got, it looks like we've got 6 questions from listeners. We're going to go through these one by one and try to provide as much input as we legally can. Go ahead and take it away.
Okay,
Doug.
The first one is from Jared. I don't think this is Subway Jared, but I'm trying to add a little humor here. Jared asks, I would like to acquire a rental property, either commercial or residential. How do I know if I'm getting a good deal? Exactly how does a bank analyze the investment? Erol, do you want to? I know you do a lot of these.
We'll get started with that. And I guess I'll start with, as a lender, I'm always asking, why does it make sense for the borrower, whoever's presenting it, the investor, whoever's presenting me the opportunity to come alongside and finance a project, whether it's a single family or multifamily rental property, commercial bay, doesn't really matter. I want to know why it makes sense for them first. But I can't answer that really in a podcast formatting because I don't have any of the data, right? But I think some of the things that we as a lender are going to look at is what type of asset class does it fit in? What type of market data can we get our hands on? There's a lot of resources that we've got. CoStar's one easy that comes to mind where you can plug in an address, it pulls up a property type, and we can get all kinds of data.
Sure.
Vacancies in that specific demographic area of Omaha. Let's say it's Midtown. I can see Midtown specific. I can look at different areas of Omaha and looking at cap rates, rental rates, vacancy rates, all of that kind of stuff, because it really matters how that asset class is performing in that area of town. But let's just use a rental property, a single family home. That's kind of a really fast growing area
So a lot of
of
people get
investing.
started
Right,
in
it's kind of where
rentals,
you
yeah.
get started, or my family's growing. I'm going to buy a different house, but I'm going to keep my old house as a rental. Right, it's the right size for a rental. I've got a mortgage on it. I don't have to change that financing, and the payments are affordable. But some of the things we're going to look at is, the valuation. What do you have to pay to get it? And is that market rate, right? That's pretty easy for us to do. We can get a full appraisal, a third party analysis of the value of that property. And typically market sales are going to provide us with that data. Secondly, what type of income is it going to generate monthly? And then we're going to use those tools and resources to say, is what they expect or project reasonable based on other assets that have the same bedroom, bathroom, square footage, maybe floor plan. If it's a 2-story, we're going to look at similar 2 stories in the marketplace, and what they expect to get in rent, or maybe what it's earning currently. Is it at or below market rents? Is there some upside to it? We're going to analyze some of that type of stuff. But then as a banker, we're going to stress test some of that, right? We're going to look at that vacancy percentage. Typically on a single family home, we're going to take a 10% vacancy. That's 1 month.
Right.
Tenant turnover, got to come in and update the property before you can get a new tenant in there.
Carpets, paint.
Right.
I mean, it's not hard to imagine losing a month's worth of rent in a scenario where you have someone move out.
Right. And as a lender, we're going to go kind of worst case scenario, right? You may never, as an investor, have a vacancy more than a week or 2, but as a lending partner, we want to make sure, can this property perform with the debt load we want to put on it if there are vacancies that impact cash flow, right? We're going to look at taxes and insurance. And one pitfall that I see investors doing, especially if they're just new to the game, is, well, this is what they're paying in taxes today.
Right.
Well, great. They also didn't pay what you paid for this property.
Exactly. And in a high-tax state like Nebraska, I mean, when you look at the percentage of your revenue you're going to be giving back to property taxes, it's a lot higher in Nebraska than it is in a lot of other states, from what I'm seeing.
So calculating at least a 90% of the purchase price, that's going to be the taxable value, and then whatever the tax levy is, we got to recalculate that payment. So we want to account for taxes and insurance, kind of that fully escrowed payment, and then we're going to look at maintenance reserves and management. Usually it's 5% maintenance reserve, 5% management fee. Worst case scenario, we have to take over management of that property. As a lender, I want to be able to absorb that management fee out of rents and make sure that at the end of the day, there's at least a debt service coverage ratio, which is the ratio is 1.25 to 1. So $1.25 of income for every dollar of debt payment that we're putting on it. But for an investor, you're more concerned about what is that rate of return that I'm going to get. Right. And so if we look at $100,000 property, $1,000 a month in rent, $12,000 annually, take out that 10% vacancy, 10% repairs and maintenance. We throw in some taxes and insurance. Let's call it $3,000. Your net income after that is about $6,600 or 6.6% return on your investment there.
Well, and the thing I always look at is you're getting a reasonable deal if the rate of return you are getting on your investment is higher than the rate that you are paying us to borrow the money. Because you don't have to be really great at math to know that if you're going to get a 5% return on the property, but you have to pay the bank 6%, you can't do that for very long and make it be a good idea. You're going to be subsidizing that investment, and at that point, is it really an investment?
Right.
I would add that I think Jared is probably not in yet. So the other question, Jared, I think you have to ask yourself is, how handy are you, and how much time do you have? And if you're going to have one property, you're probably going to be managing it yourself.
Right. If
the renter doesn't pay on time, you're going to have to be the one that tries to call them, text them, knock on, and maybe even have to knock on the door. The thing with the maintenance, as an example, I'll give you a personal one, and it's not for everybody. It's not you just buy this and, the rent's $1,500 and my fully escrowed debt service is $1,000. What if the hot water heater breaks? You got to call and you're somewhat at the mercy. But some people are really handy. And for those people, it can work out really well. Or maybe the AC goes down, the roof leaks, the doors are not working, the windows won't open, you got the tenant calling you. So you have to be prepared to have some of that. Now, if you have a lot of properties, generally you do have a property manager. But finding an electrician that you can count on, a plumber that's not going to rake you over the coals, or an HVAC person, those types of things. So I think that's a thing that you have to consider. I looked at buying a property when my kids were down in Lincoln at the North Bottoms, and I decided not to because I did the math, and I think real estate investing is good. I think the appreciation is the thing where a lot of the return comes from, is that they're buying it today, and the properties you're buying generally to rent are the ones, particularly in today's market, that everybody's competing for.
Exactly.
So you might have to pay a little bit more. So you kind of have to have some patient capital. And again, you have to have some time. Right. Because if you're eating dinner on Sunday and they call up and say, my toilet's plugged, you can't just go, well, sorry, I'm eating dinner. I mean, they're expecting you to come out there and heck, they may not even own a plunger. Right. And you're going there and that's the kind of things you're going to deal with a little bit. So.
It's not all sunshine and rainbows. Like you say, I think it can be a great business for a lot of people. We all know people personally that have made a lot of money, built a lot of wealth this way, but it is a buyer beware and know what you're getting yourself into.
Correct.
What do we got next, Doug?
This is from Brett. What is the advantage of using a financial advisor over simply using low-cost index funds?
Do you want me to jump on that one, Erol?
Go for it.
I think, in order of importance, I think if low-cost index funds, doing it yourself, you're just getting started, I think that is far better than doing nothing. The worst thing you can do is nothing to prepare for your financial future. Maybe you're at a small business and you don't have a 401k or some type of tax-advantaged investment strategy, and you're going to set up your own Roth or traditional IRA through TD or Fidelity or any one of these large online brokers. I think simply getting started, it's kind of like going to the gym. If you're going to, the most important day is the day you start. So I think, if you're just dipping your toe in the water, don't have any money invested, I think getting started with low-cost index funds is a great way to get started investing. That next step, going to a financial advisor who's really going to bring in all the information. They're going to interview you. They're going to learn about your job, your family, your aspirations, your current situation, what your goals are. And they're going to incorporate your entire financial well-being into the discussion, not just, well, if I put $100 a month in the index fund and it grows at X amount of percent. I mean, we can all run those same calculations. Right. But, the financial advisor really brings the holistic approach to your financial well-being. And they're going to set that plan for you. And then to me, maybe the most important thing the financial advisor does is they hold you accountable to that plan. Because the one thing I always think back to, because guilty is charged, February, March of 2020, for those of us at the time that were trying to manage through our investments by ourselves, I would venture to guess many of those people panic sold into the bottom of 2020. Whereas if you have a financial advisor involved, more than likely that doesn't happen.
Well, and they take the emotion out of it. I think you hit a chord there. When COVID hit, panic set in, and we were all making very emotional decisions. And when you're talking long-term financial strategy, emotion is probably not the best driver of decisions. And
Could be the worst.
Yeah, probably is. And so I think that's one area that, that the financial advisor, they get to take the emotion out of it, right? It's not their money. But they know you. They know where you are, where you're going, why you're going there, and what's most important to you, and can probably, like Doug's done a number of times, put some sense into you a little bit, talk some sense into you. Well, why would you do that?
Well, the most rational thing in March 2020 is, well, you might as well stay in the market, because if we're all going to die anyway, what's the money going to do for you, right? So it's
right. Yeah. and I use our wealth management department. Started out with Tim. We didn't have one in Omaha. We do now, Jana Wheatley. And she's going to do a great job, and she's got a lot of experience. But the one thing Tim brought to the table, and it's a little bit different than you're talking your low-cost index funds. I can remember him talking at one of our lender meetings and said, they go through everything. Like you said, a comprehensive, and the first thing he said was, one of the first questions we ask is, how's your life insurance for these people? Because most people have families or people that are depending on their income. Now, this is not on the index fund, so I'm going on a little bit of a tangent, but Tim said that with the mortality tables the way they were, that if you've had a policy for any length of time, you're paying a much higher premium than you need to. And so I didn't want to look like an idiot in a meeting. So after the meeting, I called Tim up and I said, hey, I've got these policies, and I won't say what company, and I've had them for a while. And I said, would you take a look at it? And I'm relatively healthy, right, for being old. And I was a preferred or whatever, and I didn't have any check marks and what have you. And so I ended up paying 40% of the premium that I was paying before per $1,000 of life insurance. And so that's kind of what you get there. So if you buy an index fund, I think if you're younger and you don't have a lot, periodic investing is a great idea, and you can do it very cost effectively with that. And really, at least this is the world according to Doug. If it's under $100,000, it's probably not worth managing at that point. But as like I've had 401ks, and I've always tried to do as much as I can in my 401k, and now I have all these rollovers, it's a pretty significant chunk of change, again, because accumulation, and I'm
Right.
old, and I remember in 2008 and 9, I never sold anything. And didn't the Dow go down to, and I'm bad at this, I don't know, was it
6,000?
6,000, and right now we're complaining, what is it, 32,000.
Correct.
It went up as high as 35, and I get it. I mean, the war in Ukraine, you've got some variables out there. You got inflation, but
Stay invested.
yes, exactly. And I think an advisor can counsel you through that. Right. So,
Right. I agree.
okay. The next question's from Ashley. I've heard something about an employee retention tax credit. What is it, and how do I know if it would benefit my business? Now, this one I'm not going to say I know anything about. So I think, Phil, you mentioned
yeah, I think our disclosure is you need to talk to your accountant.
Talk to your accountant,
CPA, your professional.
your CPA. This is not legal or accounting advice, because quite frankly, when I first heard about the employee retention tax credit, my question was the same as yours. What in the heck is this? So I called my accountant and said, hey, I've had some customers asking about this ERTC, employee retention tax credit. What is it? And the nice thing is he just sent me this nice little pamphlet that kind of went over the ins and outs of it. So I'm just going to hit high points on this. I think for a lot of our business customers, if you haven't heard about this, please call your accountant, see if you might qualify for this, because this is something that if you're a small to mid-sized business and you were detrimentally impacted by COVID, which many were, this could be a huge sum of money for your business. So I'm just going to hit the high points of the rules, and I'm just going to read from the notes here. But for 2021, this program, you can get a tax credit for 70% of qualified wages paid after December 31st, 2020 and before October 1st, 2021 at a maximum of $10,000 per employee per quarter. So for round numbers, let's say you've got 10 employees, they all make $40,000 a year, so you're maxing it out at $10,000 per employee per quarter. You could get back $7,000 per employee per quarter if you meet one of the two qualifications: a full or partial suspension of operations during a calendar quarter due to government COVID regulations, or a decline of greater than 20% of gross receipts, so gross revenue for your business for a calendar quarter in 2021 compared to that same calendar quarter in 2019. So if you had maybe there was a massive restrictions in your area, everybody's going to have varying situations. But if you had a 50% reduction in revenue in one of those quarters, more likely than not, you could qualify for this. Now, your accountant has to file for this for you through your payroll tax returns, But I don't see how we can go much deeper than that, because I don't think any of us are CPAs sitting at the table. But I guess that the answer is talk to your accountant.
Yeah, correct. And this might be a piece of advice for a small business person, is that you get what you pay for, right? So I've seen maybe some TurboTax stuff. I do think a good accountant is worth their weight in gold.
Certainly.
And so that's great advice. Okay. The next question from the mailbag, probably email bag, right? Can you tell us more about I-bonds? What exactly are they, and how would I go about buying some?
Erol, you want to jump on this one?
Oh, sure. I-bonds, they're inflation bonds issued by the Treasury Department. And, from my understanding, those rates are set twice a year. And then kind of depends on what inflation is going to be doing, what happens there. But in May and October, those are adjusted. Current rate
9.62%.
So just under 10%. What is it?
They're limited, correct?
Yeah, $10,000, I think.
$10,000 per person.
Per person per year.
Correct. There is a way to get an additional $5,000. You can get it through your tax return. If you have a refund coming from the federal government, when your accountant, again, have a good accountant, goes to file your income tax return, if you got a big refund coming back, you can buy up to an additional $5,000 of I-bonds with that refund directly from the Treasury. The thing with the I-bonds, I think it can be a great product for some people, but if you're a retiree and you're an individual, well, $10,000 in the grand scheme of things, probably doesn't change your life a whole lot. But it does pay one heck of an interest rate right now, 9.62%, and that's completely risk-free.
Right.
There is some caveats to them, though. Like Erol and Doug said, you're limited to $10,000 per individual per year. You have to hold them for a minimum of 1 year before you can liquidate them. So this is maybe not something you want to put if you have an emergency fund for your household, because if for some reason you buy an I-bond and you need the money 3 months from now, too bad. You're locked out for a year.
Right.
And if you hold them for less than 5 years, when you do cash them, you take a 3-month penalty on the interest that you've earned. So this is more of maybe a long-term savings vehicle of some sort.
If you have some excess cash, and again, there's really no free lunch out there. Right?
No, absolutely not.
Okay. This one is from Steve, the next question. Real estate is supposed to be an inflation hedge. Why are we seeing housing prices drop with inflation and higher interest rates? And I might be able to take that. I think it's just a pure, right now, we have a lot of things that a lot of people have never seen before. And the supply and demand in the housing market is really out of balance. It's starting to get more into balance. In other words, there was a lot more buyers than there was sellers, and it artificially, increased prices, which I don't believe are part of inflation. Those are more in the energy sector, the food sector, the
owner's
service
equivalent
sector.
rent, yeah.
And but real estate generally does appreciate. And be blessed. Let's recognize that we're blessed to live. Now, Nebraska has its faults. Okay, we're a high tax state, so there's one thing. But our economy, they say no boom, no bust. We don't have as big a booms as they do on the coasts and the larger markets like Denver and that kind of thing. So then we don't have quite as much of an adjustment. Our economy is very consistent. In Nebraska, ag, people are going to be eating. I know I enjoy a good steak, probably more than I should.
Nah.
You've got your barley for your beer. I mean, it's all there for you. So that is why I think you're seeing the prices drop. And then with the interest rates, people were focusing on the monthly payment versus the money they were actually spending for a property. And I can tell you, me personally, I refinanced a couple of years ago for 15 years at 2.125%. And it's difficult to give that up. And so with the lower interest rates, people went out and bought maybe bigger houses than might have been advisable. I was already into to the property. So I've refinanced 4 times.
Well, and I think that's when I think of real estate as being an inflation hedge. You know, the thing with real estate is the only way you get money out of it is if you lever it or you sell it.
Right.
So in my mind, it's even though prices might be coming down, as a consumer, a homeowner, it's still a hedge because whenever you bought your property and locked in your interest rate, you've fixed your cost of housing. Whereas if in this same scenario, if you're a renter, your landlord could call you whenever your lease is up and say, sorry, your rent's going up 50%. No different than a business owner on a commercial property. Same situation. If you've bought your property as a hedge against future increases in rent, you have hedged that inflation risk. Now, your core principal invested in the property can fluctuate from time to time, but that's just on paper.
Yeah.
I mean, it's one of those scenarios where you don't actually realize that loss unless, God forbid, you have to move in a down market or, you have to sell your building because you need to upgrade or whatever it might be. But I even though prices might fluctuate, I still think it can act as a hedge.
100%. And I think too, those business owners that control that asset is owner-occupied type business feature where, I've got clients that, have multiple locations, control the real estate, own the real estate in one location and don't, they're tenants in another. And, those rate increases that you talk about, I mean, can be a really negative impact to the performance of that business. And I don't think there's enough value discussed in what that looks like long term.
I agree.
Because if your business is subject to that specific location, and let's just use a daycare, for example, right? And your families are 3-mile radius probably of that specific location. And it might be in an area where you can't go across the street and buy a piece of ground and build a building and there's nothing else available. You're stuck. Right? And your landlords are going to know that and they're going to raise rents accordingly. And so it can really impact the profitability of that location. And I think it's something for business owners to understand when they're thinking long-term investments.
Right.
Can I buy the asset and control it? And what benefit does that give me long-term?
Well, and I'll just shortly add when maybe we're wrapping up this question, but I've told people before, and again, being that I'm old, right? So I've had 4 houses. All of them I've had built. And I tell people that houses are a luxury and not a moneymaker. Because if you're buying and selling, it doesn't matter where the market is, it's always neutral. Because the one you're buying or having built costs more. Yeah, you're getting a good price for the one you're selling. Everybody wants to talk themselves into they're getting a good deal.
Everybody wants a good deal.
I like the person that goes and says, "Yeah, I bought this new vehicle and a dealer gave me way more than it was worth, and I got over on that dealer." And I'm like, "No, you didn't." But again, some people get upset with me because I try to give them a little truth serum, but and you do control your costs of, like right now, I'm really happy because my wife is happy with the house, but property taxes have been going up. Of course, you've got some inflation, and then if they increase the value, so you don't quite lock down the cost of and hazard insurance. And I would just add for everybody that's in Nebraska and particularly in Omaha, I will promise you hazard insurance will go up 15 to 20% next year. Because of all the hail that we had. We had a lot of hail in Omaha. I don't know how about in Grand Island, but on June 7th, we're seeing a lot of hail checks coming in on the mortgages that we have because our name is on the check and we have to sign off. So you do, but your capital costs, and again, a home is the place where you can put a nail anywhere you want.
Right.
But if something breaks down, you're paying for it. So I've
you are
been
the
in
plumber.
my house 4 years, and I've already replaced the dishwasher.
Perfect.
So, okay, this last one, we're going to have some very robust conversation on this one. This is from Ted. So this will be a TED Talk.
There we go. It's a TED Talk.
Thanks, Ted.
How does a bank set interest rates for its commercial and ag customers?
I want Doug to jump in.
Okay.
Okay.
Well, I do sit on our senior loan committee, and we do, the lenders propose the rates. We have a pricing model that we use, and it takes into account our cost of funds. And so this is a little bit of supply and demand. So right now, to be honest with you, the supply of deposits is getting more scarce. The PPP loans put a lot of money in banks, and they sat in business owners' checking accounts.
Right.
And so that was one of the reasons rates were so low. And of course, the Federal Reserve is now trying to fight inflation. And so it depends on, most banks are very loaned up. In other words, a very high percentage of their deposits is out there in loans. So again, it's a little bit of a supply and demand, no different than oil, no different than corn, soybean. If we have drought and the harvests are a little
money
bit
is a
less.
commodity. I mean, at the end of the day.
It is. And so, but on the other hand, I would say competition sets the rates. We know the rate that we'd like to have, and we, as bankers, we live on the margin or the margin, the spread. And so, what's the average cost of our deposits? And we're intermediaries, and we pass that on to the borrowers. And the margin there, banks used to like to be around 4%, and I think we've been lately in that 3.5 to 3.7 range, and that's generally where a lot of banks are. We all compete. We're all advertising. We're in the same market, whether it's Omaha, Grand Island, or North Platte. And so if the competitor is saying, hey, we're offering a CD for 2% and your CD is 1.5%, a lot of times they're going to go, money's money. Right. Now, for the checking and those types, those transactional account, I think there's a lot of service involved there. But so again, we try to, and we look at the risk.
Yeah, it's risk-based pricing, really.
Well, we like it to be.
Should be.
and the size of the loan as well factors in. So if you have a $100,000 loan, I can promise you that the amount of work that we have to do is the same as $1 million loan.
Yeah,
absolutely. You're running personal credit. You're looking hard at personal credit. You're looking at the cash flow of the business or the individual. You're looking at the collateral. You're looking at the industry. What's the risk in that industry? Some industries have more risks than others.
Right.
And you're looking at that. So you put this in and you put it into a gumbo. And that's kind of why we do have a pricing model. Now, we're not saying, so to make $1 million loan, you got to do $100,000 loans. Now, it's not going to be 10 times the price, and that's where we get into it. But the size of the loan probably makes the most difference, because if you've got a $5 million real estate loan out there that's already built, developed, it's
gold-plated deal. Yeah.
Got a good occupancy to it, you're going to price that one awfully competitive, because, again, how many of these other loans do you have to make?
Right.
Car loans are really difficult to get a profit on those, and I'll probably get hit over the head for this, but I do tell a lot of my customers, I said, a lot of times the dealership is going to have a better deal for you. Mm-hmm. And I had a customer, and now it's probably 10 years ago, he called me and he said, what's the rate? And I think I said 4.25 or 4.5. And I said, are you at the dealership? And he said, yes. And he was getting a new Escalade, and he was getting a new work truck. I won't name the dealership. And I said, Jim, the dealership's going to have a better price for you, or rate. And he goes, I know, but what's your rate? And I told him. And I could tell from experience, his response was like, oh. And I said, did they offer you a rate? And he said, yes. I said, what was it? He said 1.9. And I said, well, I told you they're going to have a better rate, because they do automated underwriting, and we're not set up for that. We're a community
volume.
bank.
I think
correct.
Volume
And so he asked me, well, what are the payments on $50,000 at your rate? And I gave it to him. He says, what's it at 1.9? And he said, $30 a month, that's all? I said, well, yeah, but he multiplied it by 60, that's 1,800. He goes, I'd rather give you the business. So we did the loans, but here's where I'm going with this thing is that, you want to be with a banker that you can trust, that's not going to scalp you. And you're at the barbecue or you're at the family reunion and you're there, hey, I got this great car and I got this great car loan from Equitable Bank, and yeah, they gave me a 4.5 or 8, and somebody always has to one up you, right?
Sure.
Oh, geez, you paid 4.5, I got mine at 1.5, and it might have been through the captive, could have been like a GMAC back in the day,
Sure.
Or Ford Motor Credit or Acura Finance, and so. Again, I think it's a complex question.
Yeah.
We don't have set rates. We do for car loans and consumer loans because we're subject to fair lending.
Right.
And so we have to be very consistent on what we offer there. And we do have those rates, and our employees know those rates. And on the commercial side, again, there's a lot of factors. And if any of our commercial customers are listening, I a lot of times will say, well, you have a lot of good balances in your accounts, both your personal and your business. So we might price that loan a little bit better because we're loaning you back some of your own money. And it does make a big difference. So it's very subjective.
And rate, I would say too, depending on, the commercial and ag side of things, right? On the business side, rate isn't everything.
No.
And let's just call it real estate acquisition financing. Risk, right? Loan to value is a big piece of that. How much cash are you taking out of your savings account and putting down on this asset that you're buying? And how much are you asking the bank to fund, right? And all we get is a spread on that interest. That's it. We're not a partner in the deal. When it appreciates over 20 years and you sell it for $1 million more than you paid for it, that's yours. That's not ours. And so, oftentimes it's rate's important, but it's only a piece of the equation, right? How can I structure it? Well, I can give you a shorter term and lower your interest rate, but is that what's best for you long term? If in 3 years this thing balloons and rates are 3 points higher than they are today, what does that do to you?
Right.
Or to this asset, the way it's going to perform. Amortization is something that I think gets lost in the discussion with regards to financing. Clients don't really understand what that does over time or how that impacts the financial performance of that investment. And does it make sense to take, let's call it ground, and amortize it more than 10 years? Well, it kind of depends on what you're doing with it, right? Sure. And so I think that's one piece too. And I think also, Doug, we've talked over the years about, some of our best clients we got when they were in a really tough spot financially. And I think of one industry, we had a client down in Lincoln that just high illustration of the situation they were in. The bank that they were with for a decade, for lack of a better word, was choking them out cash flow wise on amortization. They wouldn't take the debt that they had and re-amortize it, lengthen out the time that they're making those payments over time, lengthen it out to reduce the monthly obligation, to give them breathing room to then rebound from some really economic downturns that impacted their financial performance. And, we look at our bars and say, hey, you've proven that you can run this business profitably. We see it right here in the financial. You've had a rough couple of years, and here's an opportunity for us to add significant value, to kind of save a business and some owners from what would certainly have been not a good situation. Take on the debt. They had plenty of assets. Collateral wasn't an issue. Management, performance, and execution wasn't the issue. It was, can we get past one piece of the underwriting, right? That wasn't making a lot of sense. They didn't care about rate. They would have paid 3 times what we charged them. Guarantee it. and I could probably bring that client back here and ask that same question. I know that they would say
exactly what it is. Yes.
Interest didn't matter because they needed help, right? And so structuring debt isn't all about what is that cost. It's about where are we going and how can we get there. Fast forward a couple of years, they were booming. Business was back above where it had ever been before. They were making more money than they ever had. And so I guess I'll digress there, but rate isn't everything.
Well, I think that kind of takes care of our listener mailbag for this week.
Okay,
Thank you for everybody sending in those questions. I think if you're listening to this podcast and you have something come to mind or another topic that you want us to dig deeper into, obviously there's a ton of knowledge and a ton of resources we can pull from here at the bank, and we can bring in other guests from time to time to help answer those questions, whether it's about your personal finances, commercial lending, ag lending, whatever it might be. We're here to help. We'd love to answer your questions. Keep them coming. We'd be happy to do another one of these listener mailbags.
Phil, if somebody wanted to ask questions, what would be the best venue?
You can email us at marketing@equitableonline.com. You can comment on our YouTube videos. You can join us on social media on either LinkedIn or Facebook. There's a number of ways you can connect with us. If you're an existing customer, call your banker. I'm sure you've got their phone number, and just reach out to them individually, and they'll pass on the questions to us.
And maybe one last thing, if you heard something, if you're not a customer and you wanted to talk to us further, give us a call. We'd be happy to answer the question, without.
Absolutely.
And if we don't know the answer, we're going to find out. And there were some of these that we had to do some research, and we don't know everything. But we're going to get you the place that can tell you, a very informed opinion.
Absolutely.
Yeah. And so again, thanks to those that submitted questions. We appreciate your time on that. And Doug, just thank you for bringing 38 years of banking experience to Equitable Bank's More Bank for Your Buck podcast. We'll hope to have you back again soon. And until next time, thanks for joining us.
Okay. Thank you.
I want to thank our audience for joining us today on More Bank for Your Buck, and looking forward to our next podcast together. Phil?
Sounds great. Thanks, Erol.
My pleasure. Thank you.
The opinions expressed by the presenters and guests are their own, and they do not necessarily reflect those of Equitable Bank. This podcast is presented for general informational purposes only and is not intended to provide investment or legal advice.